So David, we are into the second week of the new year. It looks like some numbers are improving. You were on the radio show this week, and we were going a lot deeper on some of this stuff. I know we have a limited amount of time here today, but here you are on the radio, and we were discussing how lower oil and gas prices might feel good at the pump. However, on the flip side of things, this can be bad for our economy. Interest rates seem to be good because that's heavy buying in the bond markets. That's good for mortgages, but what does that mean about the economy? So as I said, coming into the Reyes report, why should I care? What does it mean to me? And what can I do? So what say you?
Well, the jobs have been great. In fact, revisions were up over 300,000 in prior months. So jobs are strong. That's not a problem. You saw that wages were down. That's a problem. That's deflationary. You mentioned interest rates. Interest rates are falling. Why would rates be falling if you have an improving economy and the feds are ending QE and start talking about higher interest rates? Why has oil dropped $70, basically 50%, almost 60% since June of last year? These are problems. You do not generally have these types of markets when you have a healthy world economy. Now, our economy, is doing well, but the world economy, Japan has QE 10 times the size of the United States. China's growth has gone from over 10% double digits to probably under 5%. You have the European Union looking at massive QE. So the problem is that while it's great at the gas pump and in your pocketbook, and possibly retail sales probably will do well, but the problem is that this is not good for markets. Until oil stops sliding, the stock market is going to be a treacherous place to be.
So David, earlier this week, you sent me a couple slides that I thought were pretty interesting. One was an implied return from the consensus forecast, which we have on the screen right here. Let's start with this one. What are we looking at?
Yeah, I like to bring this up. Actually, I've been looking for this for a long time, and I looked at it a couple years back. And basically what this shows is historically the consensus S&P 500 targets from places like Merrill Lynch, Smith Barney, Goldman Sachs. So consensus street estimates for Wall Street. And what this shows you is kind of what a joke that is. Even in up years like 2012, 2013, the market was up a cumulative 50%, and they predicted a cumulative about 5% to 10%. And then what's worse is in down markets like 2000 to 2002, which were negative each year, cumulative 42%. Each year was predicted up 10%. 2008, they predicted markets would be up 17%. And as we all know, markets were down 37%.
Let's take a look at that second slide, David, that you provided to me earlier this week, then and now. What do we have here?
Yeah, this is basically what's called a cyclical asset pricing model, and it shows basically there's only been 3 times since 1881, which is a long time ago, where we've had prices at this stratospheric level in the stock market. This is basically a 10-year adjusted average. Those 3 years were basically 1929, the crash of 1929, the 2000s, early 2000s I mentioned, and 2008. And so my concern is that we're seeing this disconnect with oil prices, massive stimulus outside the United States, and you're seeing markets that are again at all-time highs. It's just be very, very, very careful with your portfolios right now. I would be very cautious to start the year. See what happens with earnings. Most of the earnings will come out the last week of this month. And that would be a time after kind of the dust settles and hopefully oil can get a bottom, then I would start to really adjust my portfolio and see where I want to be.
Got it. David, you got your new book out. I know you're also working on another one, and we just released this thing, Successonomics, written with Steve Forbes and other financial advisors like yourself. We are giving out a free copy of this today to any of our viewers who reach out to you and get a review of their financial plan. It just seems now going into the new year, you have risks of a 10% correction that haven't happened in a long time. The financial implications of what's really happening with oil and interest rates, and even those little things like fees that are eating away at your retirement. These are things that it's smart to do at the beginning of any year, but now is the time to get a review. So I want our team to keep that up at the bottom and give our audience an opportunity to reach out. We've made this really easy for you. If you text the number that you see on your screen, you're going to get a response from us asking for your name and email, and then I'm going to facilitate an introduction to David, and he's going to offer you a full-on free financial review. And I use the word free lightly. Usually would charge thousands of dollars for this, but as a viewer of the show this Saturday morning, if you text us free review, you're going to get a response from me, and I'm going to get you all set up with David. We're going to waive all the costs associated with this to our first 5 people that do reach out. So 619-846-9333, text free review. Shoot that over, and we're going to get you all set up. 846-9333. Of course, this is a San Diego-based show, 619 area code. Also, David's website, if you want to reach out to him that way, reyesplan.com. I should mention that David also hosts his own radio show on KFNB on Sunday mornings as well. Make sure you catch him there. David, as always, appreciate the Reyes Report, and hopefully people take action and connect with you today.
Thank you.